Hello, this is Rochelle Agatha, and this is the lecture on completing the accounting cycle. So after studying this chapter, you should be able to describe the flow of accounting from the unadjusted trial balance into the adjusted trial balance and the financial statements, prepare financial statements from the adjusted account balances, prepare closing entries, describe the accounting cycle, illustrate the accounting cycle, and then explain what is meant by the fiscal year and the natural year. So the first objective is to describe the flow of the accounting information from the adjusted trial balance, which is what we went through the last lecture. So if you recall, here's a worksheet, and this is actually a problem from the Excel course. And this is for Nikki Cleaners, and the way the worksheet works, and the book refers to it as optional, but it lays out the information in a way that I think makes a lot of sense. You start with your trial balance columns, and notice that your trial balance is always in the order of assets, liabilities, equity, revenue, expense. And then the items down at the bottom are the items that we adjusted in the last lecture. So we have our debit and credit trial balance columns. We have our debit credit adjustment columns, our adjusted trial balance, then our income statement columns, and our balance sheet columns. And basically what you do is you start out with your trial balance, your unadjusted trial balance. You plop in your adjustments, you get your adjusted trial balance, and then you place the adjusted trial balance accounts in whether they're income statement or balance sheet accounts. The key to the spreadsheet is that your net income falls out at the bottom so that your debits and credits will tie out. So this becomes a key when we look at the financial statements after this slide. The spreadsheet is set up, as I mentioned, where accounts are listed in the trial balance columns using the ending balance found from the general ledger. So these balances come from the pre-adjusted general ledger. Then your adjustments are entered in the two middle columns, and this is where we talked earlier about accruals and accrued expenses, deferred revenue, and whatnot. They're going to go in your adjustment columns. And then you're going to add the adjustments through and get your adjusted trial balance. This keeps you in balance and helps you make sure you haven't forgotten anything. The revenue and expense balances are carried into the income statement columns, and the balance sheet accounts are carried into the balance sheet columns, as I mentioned previously. So the second objective is to prepare financial statements from the adjusted account balances. So that's why you need to come up with the balances. And in real life, you don't use a worksheet. An accounting system will produce these ending balances. But when you're learning accounting, it's really good to understand the flow of the numbers. And I found that people who learn how to do accounting, maybe you're an AP clerk or a payroll clerk or accounts receivable clerk, those kinds of people tend to have a harder time understanding than those who just learn accounting by hand the way we're doing it now. So once again, here's our spreadsheet we just went over, and you're going to pull the balances from the income statement and balance sheet columns into the statements. So the first thing you're going to do is do the income statement, and note, see the $27,490? That is what we mentioned earlier, the net income that falls out from the difference between the credit in your revenue, here's your revenue, and the debits and all of your expenses. So here's what an income statement looks like. If you recall, your revenues come first, and then all of your expenses are listed out. They're typically in descending dollar order. That's pretty standard. Coming up with net income right here. Then you're going to do the statement of owner's equity, and notice that the net income flows to the statement of owner's equity. So you start with your beginning capital balance plus net income less withdrawals is your ending capital balance. Then that ending capital balance carries down to your balance sheet. So this is the order you do your financial statements. From the adjusted trial balance, you're doing your income statement, your statement of owner's equity, and then your balance sheet. And notice that on your balance sheet, your total assets equal your total liabilities plus your owner's equity. Your assets are in descending order of most current, and we're going to spend time a little later on, but current assets are things that are used up in a short period of time, less than a year, 30, 60, 90 days. whereas current liabilities are the same thing. They're liabilities that can be covered by current assets. So they're typically your accounts payable, wages payable, things like that. Also on your asset side is your equipment less your accumulated depreciation. So that's a contra account. Remember that from the previous lecture. Gives me net fixed assets, total assets. Then on the liability side, you have your total liabilities plus your capital. Remember, see that number? That came from your capital owner's equity statement. And that total is the same as your assets. So you're in balance. And that's what you want to have happen. We're going to see later on, after we learn some more accounts, a classified balance sheet where it actually will expand and adding subsections for current assets, fixed assets, and current liabilities, long-term liabilities, etc. So we mention it early on, so when the term comes up, you'll be familiar with it. As I mentioned, current assets are usually assets that are sold or used up within a year. Things like cash, accounts receivable, and supplies. Remember, accounts receivable, we're going to spend a whole chapter on it, but that is the amount of money that your customers owe you, that you've provided a service and they haven't paid you yet. Notes receivable can either be short-term or long-term, and they are written promises to pay. If they're due within a year, they're a current note. If they're due in more than a year, then they're a long-term note. And then owner's equity is the right to the assets of the business. So we like to say that the owner has a right to the business, and basically it's what's left over after you take assets less liabilities. The third objective of this lecture is to prepare the closing entries. And the process of the accounting cycle, which we're going to summarize up at the very end, is that you're going, as you know, as of now, you've learned how to analyze your transactions, perform your transactions, post your transactions, adjust your accounts, and now we're preparing the statements and we're closing things out. After you perform your closing entries, you're ready to roll to the next period. So that is the point of preparing the closing entries. Closing entries are posted out of all the temporary accounts, and at the end they will have a zero balance. Accounts are relatively permanent from year to year, and those kinds of accounts are called permanent accounts, things like cash, liabilities, fixed assets, etc. Accounts that report amounts for only one period are called temporary accounts. Those are all of your income statement accounts and your drawing account. So those are the ones that you clear out every year, empty the buckets, and get yourself ready for the next year or the next period. To report the amounts for only one period, the temporary accounts have to be zeroed out. So as you start learning more about accounting, and if you actually work in the field of accounting and you know that you prepare an income statement every month or every quarter, every year, you have to zero those accounts out at some point so that they can capture the information for the next period. And they are closed through something called an income summary. The income summary is a holding account. It is not, you don't see it on your income statement or your balance sheet. It is a holding place to close the balances of your temporary accounts. The balance of the income summary is then transferred to the capital account as well as the drawing account, and it all washes through capital, and that's how an owner's equity account gets updated. And this process is called the closing process. So here's a visual for you. Your expenses are transferred to your income summary. Your revenues transferred to your income summary. You do your revenues first, then your expenses. Then the net of that is your net income. That's transferred to your owner's capital or owner's equity. And the drawing account is also transferred because it's a temporary account. So this is a good visual to have for your card if you're making note cards. Here is what the closing process looks like. So if you, in this instance, you'd have your revenue would close out into income summary. Your all of your expenses would close out. And notice here's that net income amount of $27,490. So look, if you go back and look at the worksheet, the revenue was this. Here were all my expenses. The net of the two income summary debits and credits is the $27,490. So it all ticks and ties out. And then the drawing is closed into capital. So here you see revenue closing to income summary, expenses closing to income summary closing to, oh, that's a mistake. It should say capital there. I apologize. and then drawing closing to capital. So it's all washed through the capital account. After the closing entries are posted, all of the temporary accounts have zero balances. And the way that you prove that is you look at your post-closing trial balance and you see that all that's remaining is the permanent accounts, the cash, the supplies, the prepaid insurance, equipment. And then on the credit side is your accumulated depreciation, accounts payable, wages payable, and the capital. And you're in balance. So notice that your post-closing trial balance is much shorter than your previous set of trial balances. At the end of this chapter, and when you're done reading the concepts from this, you have completed the accounting cycle. And from here, we basically just build on concepts. So it's really important that you understand how we got here. And if you don't, you need to go back and do some more homework and do some more reading, because from here we just build on our vocabulary and our thought process. The accounting process begins, as I mentioned, with analyzing and journalizing. Then you prepare the records for the next period's transactions. And there are 10 steps. And I've shown this slide in every lecture, and we're going to show it again because it's really important. Once again, here's our 10 steps. We analyze and record in the journal. We post from the journal to the ledger. We prepare the unadjusted trial balance. We adjust the date, look for adjustment data. We gather it, we analyze it. We do the optional end of period worksheet that we've just seen. We record the adjusting entries. We prepare the adjusted trial balance. We prepare the financial statements. We record the closing entries. And we prepare a post-closing trial balance. Those are our 10 steps in the accounting cycle. And it's really important at this point that you feel comfortable with those steps. We've come a long way in a very short period of time. The last thing I want to mention from this lecture is accounting periods. Most people think of an accounting year as a calendar year. There is also an annual accounting period known as a fiscal year, and a business can adopt a fiscal year that makes sense to them. Governments typically start in June. There's cities that have like a September start date. As long as your fiscal year is a 12-month period of time and you adopt it when you adopt your business, you're fine. If it follows your operational points, it's called a natural year. So some agricultural businesses want their ebbs and flows in their fiscal year, and it's a natural year. It's just another way to think of it. Just to point it out again, an annual accounting period is 12 months, and it can be a calendar year or a fiscal year, and a business decides that, and they state why they decide that up in the beginning when they establish their business. Here's our lecture summary. We talked about the optional end of period worksheet. We recorded adjusting entries. We prepared the adjusted trial balance. We prepared financial statements. We recorded closing entries. We prepared the post-closing trial balance. And at this point, you should be good to go. Look over the homework, and if you have any questions, go ahead and send me an email. Thanks.